Every time you apply for a loan, a mortgage, or even a credit card in the United States, the bank runs a detailed background check, not on your character, but on your financial habits. It's a quiet evaluation that happens behind the screen, but it determines everything, whether your request gets approved, denied, or delayed. And what most people don't realize is, every bank looks at almost the same 5 things before making that decision. 5 key checkpoints that decide if you're financially trustworthy or not. Let's break them down, one by one. 1. Credit score, the first impression. Before anything else, banks check your credit score. It's a simple 3-digit number, but it carries the weight of your entire financial behavior. Think of it as your reputation in the world of credit. A high score means consistency, discipline, and reliability, the kind of traits banks love to see. Typically, a score above 700 is considered strong, and anything beyond 750 makes you a low-risk borrower in the bank's eyes. But this score isn't built overnight. It's the result of years of on-time payments, responsible credit card use, and low outstanding balances. Even a single missed payment can leave a dent that takes months to repair. So when banks see a clean, healthy score, it tells them you respect credit, and that's the first sign of trust. 2. Credit history, the story behind the number. A good score gets attention, but the real story lies inside your credit history. This is where banks open the pages of your financial timeline. They look at how long you've used credit, what types of accounts you've handled, and whether you've made payments consistently. Someone with a 5-year-old credit card, paid on time every month, shows maturity and stability. Someone new to credit might still be figuring things out, and that uncertainty makes banks cautious. Credit history also reveals how you've handled debt under pressure. Did you close old accounts responsibly? Did you max out your cards? Did you ever default on a loan? All these details paint a clear picture, and this picture, more than just numbers, tells the bank how predictable you are with money. 3. Debt-to-income ratio, the balance between earning and owing. Now the focus shifts to your income, but not just how much you make. Banks want to know how much of that income is already being used to pay off other debts. That's your debt-to-income ratio, often called DTI. It compares your total monthly debt payments to your gross monthly income. For example, if you earn $5,000 a month and pay $1,500 toward loans or credit cards, your DTI is 30%. Banks prefer this number to stay below 36%. Anything above 43% is considered risky territory. A healthy DTI shows that you have enough breathing room to take on new financial responsibilities. It proves that your current debt isn't controlling your cash flow, you are. 4. Recent credit activity, the pattern of behavior. Even if you have a solid score and income, banks still look at your recent moves. They check how often you've applied for new credit in the past few months. Every time you apply for a card, loan, or financing option, it leaves a hard inquiry on your credit report. Too many of these in a short period signals financial instability or over-reliance on borrowing. From the bank's point of view, frequent applications mean you might be desperate for credit or juggling too many financial obligations at once. That's a risk they avoid. So, a calm, measured credit history with few inquiries shows self-control, and that's a big plus. 5. Income and employment stability, the foundation of trust. Finally, everything comes down to one simple question: how stable is your income? Banks want to see consistent earnings, month after month, year after year. That stability gives them confidence that you'll repay what you borrow. For salaried individuals, this means showing steady employment history, preferably 2 years or more with the same employer or in the same field. For freelancers or self-employed people, consistency in cash flow matters more than the amount itself. Pay stubs, tax returns, and bank statements all tell the story of your financial rhythm. Because even a great credit score can't replace the assurance of steady income. Final thoughts. Every financial approval, whether it's a small personal loan or a major home mortgage, is built on these 5 pillars: credit score, credit history, debt-to-income ratio, recent activity, income stability. Together, they reveal who you are in numbers, discipline, and habits. Improve each of these slowly, and your chances of approval rise naturally.